there's only one way for the United States to be able to reindustrialize the way it needs to, right? And the AI proliferation that's hitting every part of our lives. The bottleneck is not chips. The bottleneck is not data centers. The bottleneck is not tokens or blockchain. The bottleneck is there isn't enough electricity.
And that means we are about to see a surge in capacity build out in terms of power plants here in the United States. And that is going to be an investment story no one is quite comprehending just yet.
And there's only one way to get that electricity. There's only one type of fuel that in the next 3 to 5 years can give the kind of levels of electricity the U.S. needs. And for those reasons, there's a couple of stocks we really love that fit the bill.
We're going to dive into that, and also a special look for a 3-minute drill on one company a subscriber asked us to look at, Sunoco, today on Altimetry Authority.
Let's talk earnings and some favorite pastimes.
So let me just say, earnings
Wall Street
is
2.5x
because their compensation goes up.
Wall Street's wrong again.
You know, it seems like you can't look anywhere without people talking about how data centers are seeing an explosion in build out because of AI. It does feel, though, that people may not comprehend just how much data center build out is going on here, everybody. So just for context, right, from 2021 and before, like on average, right, in terms of the amount of money the amount of data center capacity, when you always talk about data centers, ironically, not in terms of how much data they process. You almost always talk about in terms of how much power the data centers consume. Data center capacity in terms of what was adding was probably around, 2 to 3 gigawatts a year of data center capacity was added. But in the last 2 years, in 2024, we went to adding 30 gigawatts of data center capacity, and we have not slowed down. This year, we're forecast to add 80 gigawatts worth of data center capacity because of the explosion we're seeing in AI. And you can see it. AI truly has been the inflection here. From when ChatGPT launched, right, in terms of the construction spend on data centers, it has more than doubled over the time period. And the really interesting thing is, this is really almost exclusively right now a U.S. phenomenon, right, Joel?
Yeah, it's pretty amazing that the 30 gigawatts, you're talking more electricity than most states consume, right? Most states don't consume 30 gigawatts, and that's how much that the build-out has been in terms of what's needed for AI data centers. Now, the good news is is that if you don't have the AI data centers, you're not going to have the AI training models, which means you're going to lose the AI race. The good news for the United States is that the U.S. has more AI data center capacity than all the rest of the world combined, right? So I know there's been a lot of talk about China's right there. China's catching up, and I think we do have to worry about China catching up, but they're still number 2 and a way, way, way behind number 2. And the rest of the world is just going to rely on whatever U.S. and China builds. And in many cases, probably rely on the U.S. because they probably have more feeling that their IP won't be stolen, where when you use a Chinese AI, they're more likely to steal your IP because they have been doing it and there's nothing you can do about it, versus U.S. companies where they might steal your IP, but you could probably still sue them and win afterwards. So anyway, the U.S. companies have dominated in terms of the AI data center capacity. And if the U.S. realizes that the bottleneck to this is not more tokens. And in fact, as you can see, it's not more data centers. I mean, the U.S. can build as many data centers as it needs. The problem is electricity. There just aren't enough electrons.
Right? Exactly. And so you get into this, and this is wild. The issue around electrons is such a big one around power that literally in Silicon Valley itself, right, where NVIDIA, right, the maker of GPUs, NVIDIA, and Blackwells and everything else, where they are based, there are data centers that are there sitting there, including NVIDIA data centers and everybody else, that literally can't turn on. And they can't turn on because of power. And even, Satya Nadella, right, the CEO of Microsoft, literally said, look, we've got plenty of GPUs. We got all the GPUs we need. We got GPUs in inventory that we're waiting to hook up. The issue we have is we do not have the electricity to be able to power them.
Yeah, Sam Altman also mentioned on top of that, and he said very recently in an interview, and they said tokens are not the bottleneck, right? The chips are not the bottleneck. There's more than enough chips that we can get if, right, we need them. The issue is we don't have enough electrons. There is not enough electricity capacity to power all the AI data centers that need to be built to power AI, and not just AI, the entire reindustrialization of the United States, right, is going to require so much more electricity than is available now that electricity production is the bottleneck to succeeding in AI.
Right. I mean, just to put this in perspective, everybody, literally, Microsoft's president, Brad Smith, literally came out and said, look, what we need, our solution to this is we need 500,000 more electricians. That's what we need because of how urgent the demand is for power. But let's just put in perspective how much this gap in power demand really is, because I don't think that a lot of people don't quite wrap their mind around this. So this is just from Morgan Stanley, right? Morgan Stanley basically says, hey, look, we need for data centers by 2028 about, call it 70 gigawatts of incremental power. By the way, not to mention the fact that we literally just said we're adding 80 gigawatts of capacity of data centers this year, but fine, let's assume that they're actually right. They're probably too low, but let's assume they're right. What they're saying is between grid capacity and behind the meter, as it's called, basically power plants, solar plants, battery backup solutions that are co-located with data centers as opposed to being hooked up to the grid, between all those, we're going to get about 25 gigawatts, which means we're going to have a shortfall of about 45 gigawatts by 2028. But if you really dig into the data, you see that number is way, way, way too low. So this here is FERC. So FERC is the regulator for the U.S. power grid, right? They are the ones who basically decide who is allowed to hook up their power plants to the grid. When are they allowed to hook them up to the grid? How do the different grids, the grid in New England versus PJM, which is, right, the grid for Maryland, Virginia, and Pennsylvania, part of Ohio and all that stuff, or ERCOT in Texas or out west. They're the ones who regulate all that. They basically take in what people's forecasts are for demand. And you always talk in power, the idea of summer peak demand. And the reason why you do is because the summer with air conditioning is always when you get the biggest consumption demand. Well, in 2022, looking out to 2030, they were saying, hey, we're probably going to see peak demand go up by 22 gigawatts. By 2023, as AI models started really picking up and data centers started picking up, they go, maybe it's not 24 gigawatts, maybe it's 38 gigawatts. By 2024, it was 60 gigawatts. And in 2025, it was 170 gigawatts. Now, if you think that this number is going to stay at 170 gigawatts, you are totally missing the thread of the conversation that we've been having already. But let's give the benefit of the doubt and assume it's going to be 170 gigawatts. Well, the first thing, and Joel, you mentioned this, everybody, this is not a phenomenon of just data centers. Data centers are going to be a little bit more than half of that increase in peak summer demand for power. But another basically 20-25% of it is the reindustrialization of the United States of America. That is really happening in a big way because of the supply chain super cycle, as Joel and I talk about regularly, because of everything that President Trump and the administration are doing in terms of tariffs to bring stuff home. All that's going to keep on accelerating too. So that's probably too low also, but 170 gigawatts. So here's the thing. The good thing, utility companies understand this is an issue. We are seeing utility companies forecasted to double their Capex spending on power plants from where it was in the late 2010s to over the next 5 years on an annual basis. On an annual basis, they will have doubled capacity. Just from 2024, by 2027, you're going to see growth of roughly, call it 30 to 50%. So what does that mean? Hey, great news. Remember we said 170 gigawatts is needed? We're going to add 490 gigawatts. That sounds great, right? Well, there's a little issue here. And that little issue is not all power is created equal. When you talk about AI data centers, or also factories for that purpose, you care about what's called baseload power. Baseload power is power that can be on all day, every day. People don't stop actually interacting with ChatGPT or Gemini or Grok or Perplexity or anything else because it's 9 p.m. and the sun went down. Oh, guess solar power plants aren't on. I'm not going to use my AI. I know I can't. You don't see that happen. And so there's different kinds of power that is not qualified to be able to be used by AI data centers, by factories or anything else. So, from that 500 gigawatts that's being added, guess we got to strike out 60 gigawatts of that because that's wind. It's not always windy enough to have wind power. And by the way, also, sometimes it is too windy to have wind power. Don't know if you know this, everybody, but wind turbines, you can't run them if it's too windy because it'll tear the turbine apart. So you literally lock them and shut them down. Oh, sorry. It's not sunny at night. And so we can't rely on solar on its own for baseload power. And battery backups, we're saying there's going to be 150 gigawatts. That is still not a proven technology. So let's leave that up to your question. The only of these additions that we're talking about here that genuinely can be baseload power, the 50 gigawatts that we're seeing talked about in terms of being added by natural gas power. Notice there's no nuclear on here because nuclear takes 10 years to build if you're lucky. It's not just that we're only adding 50 gigawatts of baseload power. It's we're also taking power out of the utility market as well, right? Power plants don't last to infinity, and coal power plants have been actively decommissioned over the last few years and are going to continue. This chart right here, this is how much power is going to be decommissioned in the next 5 years. We got 60 gigawatts of coal. We got 40 gigawatts of natural gas. We got 17 gigawatts of oil. We got 2 gigawatts of nuclear. All that's baseload power right there. That's not wind and solar. That's baseload power that we're taking out of the grid. So let's just do some simple math, right? 150 to 170 gigawatts of baseload power is needed to be added by 29 or 2030. And we're generous. We said 150. Let's not even make it 170. Let's make it 150. Well, we're going to add between 50 and 200 gigawatts of new baseload power. All right. But we're also going to take out 115 gigawatts of baseload power. That means we're going to be between shrinking our baseload power by 50 gigawatts, right? 50 minus 110, or growing it by 90 gigawatts when we need 150 gigawatts added, even if we are in the best case scenario, which we all know that we're going to end up needing more power. And so we're going to have a shortfall in 29 or 2030. It's real. We need to build a ton more power plants. And by the way, we are already seeing this impact things. What this chart shows you right here, this map is a map of the cost of power throughout the United States of America. Where you're seeing those yellow dots, that means from 2020 to 2025, the price of power has gone up. So in Baltimore, right, the price of power has gone up 125% in the last 5 years. In Buffalo, it's gone up 200% already, and we haven't even hit the worst part of the story in terms of when we're going to see demand for data centers. So what all this tells us, everybody, is, yes, we are happy that utility companies are scrambling to build more power plants, but we're going to need a lot more power plants beyond that. And those power plants are going to have to be powered likely by one specific kind of fuel that can fuel it. And so because of that, Joel, we found two really interesting companies that we think are going to be big beneficiaries of different parts of this whole entire build out. You want to take everybody through Primoris and Antero?
And that's the issue. Because people say, so electricity is important, let's go buy an electricity company. Well, hold on a second. Most electricity companies are regulated in terms of pricing. They have no control over costs. Costs can skyrocket. It gets more and more expensive to build out these electricity plants. But customers go crazy and they call their congressman and they will de-elect you as a congressman if you let your electricity bill get too high. So we don't love electricity companies for this. So it's kind of interesting when you say, I love the AI revolution and I realize the U.S. is being re-industrialized. What should I buy? We say, well, don't buy electricity company. Buy the providers of electricity. And when you look at that, we have to say we want to look at a couple places. And one is Primoris Services Corporation, because they're the construction and engineering company that really specializes in building electricity plants, which we're going to have to see many, many more of. And particularly, as Rob said, gas-driven electric turbines, because that's the only real solution for the United States. Why? Because it takes nuclear several years to build out. Rob said 10 years. I'm hoping 6. I'm hoping we don't have to wait 10 years, but I'm hoping 6 might work, 6 or 7. But yes, it takes a long time, so that's not going to be the solution. And the renewables aren't the solution. The battery capacity isn't enough. You have to turn natural gas. And the U.S. has more than enough natural gas coming out of all these areas of the U.S. One thing you might have missed is in Rob's map, the one area of the country where electricity prices have been dropping are the areas that are co-located to where natural gas is being drilled. We look at these orange numbers, it says not a great business, 5-6% returns, cost of capital. That's as reported. In reality, it's a 10+% business on return on assets, maybe even 12-13% in 2024. Wall Street understands what we're seeing, and they're predicting that the numbers will increase, but not by a whole lot. I mean, they're going to 15%. But you're talking about an industry where if you need to build an electricity power plant, there's not a lot of places to go. You're going to have to go to them. They're going to be in high demand. I don't see why Wall Street might still be a little bit conservative here. And if we look at the market's pricing in, the market's saying, yeah, Wall Street has the company doing a little better, but we're just going to hold it there. as if this phenomenon of needing gas-driven electricity plants is only going to last a year and then just kind of like hold steady state, as opposed to all the case we made that no, this is going to be a 5-year plus trajectory of just things going up, and Primoris is going to benefit as Primoris shows return to assets that are far higher than the setting the line that the market's pricing in right now. This stock has a tremendous amount of upside. It's already up a decent amount, but has a lot of room to grow, a lot of long legs on this one.
Well, I mean, to your point, Joel, right? When you look at this for Primoris, again, we talked about the idea that just because of what the current assumptions are for power demand, we are already seeing spending for utilities for power plants double. You think that with everything that we just talked about, everybody, that's not going to be more than doubling? And if it's more than doubling, Primoris makes a lot more money than they're forecasted to make in 25 and 26, which is why, Joel, as you said, even with the stock up, basically call it, 50% or so in the last 50 to 65%, it's 50 to 70% in the last year, we think there's a lot more room to run. But right, Joel, it's not just that, it's Antero Resources, which everybody, just for context of what Antero is one of the largest natural gas producers, right? People pulled natural gas out of the ground and distributed around the United States and right onto LNG ships. They're one of the biggest producers of natural gas. And Joel, I mean, we just think that they're going to be a big winner, and the market misunderstands this one too, right?
Yes, I mean, the orange numbers here are a little bit higher, 10% returns for Antero. In reality, the company's, uniform accounting numbers are saying 2024, not as good a year. Now, this is exploration, right, and production. So you expect to see a lot of volatility from year to year. So when you think about the forecast, you want to think through like cycles. You want to say, what would the mid-cycle be, right? And we're saying, all right, in a great year like 2022, they had a 10% return. In a bad year, of course, it's slightly negative. Wall Street's saying, yeah, but you're probably going to be around a 2.5% return. Let me tell you, that's a very, very, very low return. The market, at the current stock price, right, with the market cap around $10 billion, right, is saying that 4% return on assets, and that's the mid-cycle. So when you think of these, it's going to be lumpy. It's going to be volatile because, right, they're drilling, and they're saying when they hit big, and they could be some, big years and slower years. But that's the mid-cycle. 4% as a long-term mid-cycle for a fuel that is absolutely necessary, 100% necessary for the United States to stay ahead in the AI wars that we have with China, right, to stay ahead in the reindustrialization of the United States. You can't get by without gas. 4% seems like an awfully low number for a company like Antero, and that's another reason we think there's a lot of upside on this stock.
Yeah, everybody, for context on this for Antero, when you look back at their return on assets before 2015, when the bottom fell out of the natural gas market, this is a company that pretty consistently was generating high single digits, low double digits return on assets. And so when you put that in perspective, and the whole entire space was, all of the natural gas E&P exploration production companies were, and when you think about how we are going to be using a lot more natural gas to power all of these power plants, you are going to see that kind of pricing power come back for natural gas, and the market is not pricing that in, especially with, right, I mean, these companies, basically Antero Resources, the stock is effectively sideways since the beginning of the year, not nearly pricing in the massive change in demand for natural gas we're seeing, why it looks super compelling. But everybody, before we leave and sign off, we have a company that one of our subscribers asked us to do a 3-minute drill on, which we want to jump in. It's not necessarily power or natural gas driven, but it is related to the hydrocarbons. It's a company called Sunoco. For those of you who don't know what Sunoco is, I'm going to be overly simplistic here. Sunoco basically dominates the gasoline distribution market. So getting gasoline to the gasoline stations. It also has some midstream business, which is pipelines, right, that transport stuff around. But the biggest business that they have is really getting gasoline to where it needs to be. And when you look at this business, Joel, we thought there were some interesting things that jumped out that make it worthwhile for this 3-minute drill that one of our subscribers asked us to. So, Joel, let's set the line, as we say.
So, by request, the orange numbers we're looking at as reported return on assets, around a 5% return, not a great 2023. In reality, the numbers were much better in 21, and they've been steadily falling since. Now, yes, the numbers are higher, but it's important to note that they were much, much higher and trending down, right? So now we can see that. What does Wall Street estimates have on Sunoco? Wall Street says that downward trend will continue into 25, and somehow miraculously gas distribution, right? Gas distribution business rebound in 2026. The stock market says, yeah, that might happen, but we're going to price at a mid-cycle of, just around, 7, 8% in perpetuity. Now, of course, the expectation is it'll have some good years and bad years. When you model these kinds of companies, you model the mid-cycle year into perpetuity and say it'll travel around that number, and that's what's priced in. That's setting the line. That's not my forecast. That's not Rob's forecast. This is what you need to get to the current stock price. So that's what you're betting against if you bet on Sunoco.
And so what's interesting for this is there's another part of what you're betting on for this right now is you're also, when you're buying Sunoco, you are getting everybody a 6.7% dividend yield. And so what we thought would be interesting to look at is to contextualize that with another part of what we do whenever we analyze a companies, which is to analyze the cash flows and obligations of a company. We call this our credit cash flow prime because we focus on it for the debt side of the business, but it is also very relevant for dividends. And so what we do is for the next 5 years, we build out all of the obligations for a company, its cash flows, to see, can this company, one, cover its debts, but two, can it cover its dividends? And so let's take a look at Sunoco. If you look, the bottom bar that we do for any of these companies, when we look for the next 5 years, we say how much debt is maturing any given year. That's that bottom bar there. Then we look at interest expense. How much interest expense does the company own? Then we look at any rental expense the company has. And then we look at dividends. How much are the dividends the company is going to have to pay each year for the next couple of years? Then we look at pensions, R&D, maintenance, Capex, and then we look at cash flow, right? Uniform cash gross earnings. And we look at how much cash is on hand for the business. So this is year one. This is 2025. The reason why this chart looks so small, those stacked bars do, is because we're already 3 quarters in terms of financial data that we have through 2025. So we're really only looking at the last quarter here for this. But now let's look at 26. 26, even with the debt maturing for the company, thanks to all the cash this company has on hand and the flexibility they have in maintenance Capex, this company's going to have no issues covering all of its obligations. Now in 2027, assuming the company doesn't refinance any of its debt, which the company has basically every single year refinanced its debt, as all MLPs, master limited partnerships, the kind of companies that's why you see LP there. A lot of these distribution businesses, they're structured as LPs for tax beneficial purposes. But this company, if we look, it can handle even that massive debt maturity in 27, even if they don't refinance it in 28. And basically in 29, they would either have to slightly cut Capex, or even if they don't slightly cut Capex, just refinance that debt. And no matter what, they're going to have no issues paying this dividend. This 6.7% dividend yield is not going to be an issue at all. And so we look at that and we go, yeah, that alone is a reason, because a 6.7% yield is a tough thing to find, especially for a company that, is basically right now in the worst that it's been and already bouncing back. Looks really interesting. So this is one that we think that everybody should take a look at. And by the way, if you're also interested in that whole entire conversation that we just had about AI, power demand, and natural gas, and the idea of ways that you can benefit from it, we actually just put together a little while ago a very special report talking about the demand for commodities like natural gas and how it's surging because of AI and everything else, and how you can actually benefit from that, and some interesting companies we think will be big beneficiaries. We put it together in a special report at newenergyboom.com. If you want to check it out, click on the link there. And as always, if you have a company you want us to do a deep dive on, or you want to argue with us about whether or not AI really is going to need all that power, I think we all know the answer is it will. Feel free to drop that into the comments. And as always, hit that like and subscribe button. And thanks so much. That's this episode of Altimetry Authority. Bye, everybody.